Okay, let's unpack this. The mission today is to deep dive into a truly defining player in the U.S. energy landscape,
Yeah.
Devon Energy Corporation.
Okay.
If you're trying to understand how massive wealth and operational scale are built in the modern American oil patch, this is really your case study.
It really is. It's a perfect example.
The source material we've synthesized for you today, it provides a really comprehensive look at the company's entire journey.
I mean, it has to be comprehensive.
It does. We're talking its origins, its just staggering financial footprint, the vast strategic shifts achieved through decades of multi-billion-dollar acquisitions, and then, these equally aggressive divestitures.
It's a story of constant reinvention.
It is. We're tracking a corporate timeline that literally tore down and rebuilt its own operational geography, multiple times?
Multiple times. And that strategic rebuilding is what establishes the so what for you, the learner. It's not simply about dissecting one independent energy company's balance sheet.
No, it's bigger than that.
It is. It's about understanding the anatomy of corporate growth and, like you said, self-reinvention in the modern hydrocarbon sector. We're asking, how is that immense scale actually achieved?
And how do you keep it?
Exactly. How do you maintain it when commodity prices swing so wildly? And what are the inherent trade-offs, the risks and the rewards involved in shifting from this sprawling global entity to a laser-focused domestic expert?
We'll be looking for patterns, right?
Profound patterns in their strategic pivots. Absolutely.
Absolutely. You're going to see a company that systematically moved from being a globally diversified deep water and conventional player to what we call a highly concentrated U.S. unconventional shale expert.
And that move wasn't cheap.
Not at all.
Yeah.
It's a costly, high-stakes masterclass in reading the geological and, frankly, the political tea leaves, and then executing a corporate transformation that, very few companies actually manage to do successfully.
Well, let's get into it. Where does the story start?
Let's start with the genesis. Devon was not the creation of some massive legacy trust. It has a very distinct, almost family-centric origin story.
Right.
It was founded way back in 1971 by John Nichols and his son, J. Larry Nichols.
And that generational partnership, that's a key detail. It provided a powerful long-term vision right from the very start.
So it wasn't just about the next quarter's results.
Not at all. For many years, they operated privately, which allowed for patient, long-term growth without those immediate pressures of quarterly reports.
Okay, but at some point, they needed more capital to really grow.
And that's the critical inflection point. The moment for their ultimate expansion came in 1988 when they executed an initial public offering, an IPO.
The IPO.
Going public provided that necessary infusion of capital, that financial rocket fuel that was required to embark on the aggressive acquisition-led growth strategy that really defines their later history.
So beyond the financing, let's talk about their structure, their physical and corporate structure.
Okay.
Like many major U.S. corporations, they are organized in Delaware.
Which is pretty standard for a lot of legal and tax reasons.
Right, but their operational heart is anchored firmly in the mid-continent, specifically Oklahoma City.
Their headquarters is the iconic 50-story Devon Energy Center in Oklahoma City. And what's fascinating contextually is the intentionality behind that location.
What do you mean by intentionality?
Well, they closed their significant downtown Houston office, the one in the Allen Center, back in 2012.
Right as the new OKC headquarters was completed.
Exactly. That move wasn't just a simple relocation. It was a deliberate strategic choice to consolidate their global operational center away from Houston.
That's a huge deal. Why move from Houston? I mean, it's the undisputed energy capital of the world. Doesn't that risk isolating them from the financial and talent pool of the Texas Gulf Coast?
It's a fascinating trade-off, Houston is competitive, it's expensive, and the workforce can be very transient.
A lot of churn.
A ton of churn. By anchoring themselves in Oklahoma City, they doubled down on their roots, on their core mid-continent resource base. It signaled a dedication to a more cohesive, perhaps less volatile corporate culture.
Embedded closer to where it all started for them.
Right, embedded closer to their earliest, most consistent areas of operation. It suggests they were prioritizing operational stability and local community commitment over, say, the flash and the constant motion of a global hub like Houston.
So it was a statement of identity.
It was a calculated move to reinforce their identity as a leading independent producer focused on U.S. land assets.
That reframing makes a lot of sense. So let's look at their sheer scale today. Based on 2024 data, this is Well, it's not a small independent driller.
Far from it. When we measure corporate size, Devon ranks 267th on the Fortune 500 list.
Which puts them squarely in the upper echelon of American companies by revenue.
Absolutely. And globally, they are recognized as the 607th largest on the Forbes Global 2000. That gives you a really tangible sense of their weight and influence, particularly within that crucial segment of independent oil and gas producers.
And diving into the raw financials from 2024, the figures just, they demonstrate the staggering value generated in this industry.
They really do. Their revenue stood at US $15.9 billion.
$15.9 billion.
And that translated into a net income of US $2.89 billion. Crucially, their total assets hit US $30.5 billion.
Of $30 billion in assets.
When we discuss corporate strategy, we have to remember the sheer scale of the balance sheet they're maneuvering. Managing an asset base of that size requires not just geological expertise, but world-class financial engineering.
What immediately stands out to me when you contrast those figures, $30.5 billion in assets and nearly $16 billion in revenue, is their employee count.
Yes.
They achieved this massive scale with only about 2,300 employees as of 2024.
And that contrast is the clearest illustration of the technological revolution in modern energy extraction. It just highlights the hyper-capital intensity of the sector.
So it's not about manpower.
Not at all. They are not relying on massive labor forces. They're relying on sophisticated, often automated horizontal drilling rigs, advanced seismic imaging, and these complex multi-stage hydraulic fracturing techniques.
It's an efficiency model.
100%. Maximize production per employee through technology. Of course, this introduces a different kind of risk, right? Like reliance on a highly specialized labor pool, increased cyber vulnerability. But the cost savings are just enormous.
In terms of what they actually produce, their output is the classic hydrocarbon trifecta. Petroleum, which is crude oil, natural gas, and natural gas liquids, or NGLs.
And their 2024 daily production output was significant, 737,000 barrels of oil equivalent per day.
750,000 barrels equivalent every single day.
Every single day. That kind of volume requires constant, complex management of logistics, geology, market strategy. It's a dynamic, very high-stakes game.
Which leads us directly to how they manage the volatility, because that's what this business is all about.
The volatility inherent in selling massive volumes of commodities, yeah.
The energy sector is just infamous for its boom-bust cycles. So how has Devon handled that intense financial pressure? We saw a really painful period of austerity back in the middle of the last decade.
Correct. In February 2016, during a severe commodity price slump, Devon showed its capacity for decisive and, frankly, painful action.
What do?
They announced layoffs of 1,000 employees, including 700 right there in Oklahoma City, which was a deeply felt local impact.
Wow.
And at the same time, they drastically cut their quarterly dividend to just 6 cents per share.
From what to 6 cents? That's a massive cut.
It was a huge cut. And that move signaled that preserving cash and protecting the balance sheet was their absolute uncompromising priority during a downturn. It's just the brutal reality of capital discipline in a commodity-driven market.
But the critical point isn't just the cut itself, it's the strategic contrast that followed. They used that brutal lesson to fundamentally redesign their contract with their shareholders.
Exactly. Fast forward to 2021, and we see a major strategic pivot. The company instituted a fixed plus variable dividend structure. This is a powerful, very modern strategy for independent producers.
Can you elaborate on that for the learner? The mechanism of that variable dividend structure. How does it dynamically respond to those price fluctuations, and what's the strategic appeal for investors?
Okay, so the fixed component ensures a steady, low baseline return for shareholders. It offers reliability.
Something you can count on.
Right. But the genius is the variable component. This variable payment is directly tied to the company's excess free cash flow.
So the money left over after all the bills are paid.
After all operating and capital expenditures are covered, yes. When oil and gas prices spike, cash flow surges, and Devon is contractually obligated to pay out a predetermined percentage of that excess cash flow, which often results in a record-high dividend for that quarter.
So investors get a piece of the good times.
A huge piece. The strategic appeal is that it aligns the investor directly with the cyclical nature of the business. Shareholders get high returns during the booms, and the company avoids locking itself into an unsustainable high dividend during the busts.
Which is what crippled a lot of the legacy oil companies.
It's exactly what crippled them. This is a much more flexible and resilient approach to capital return, and it demonstrates that they learned from that near-death experience of 2016.
Before we jump into the massive M&A timeline that created this giant, Let's quickly look at the leadership transitions. Executive shifts often reflect these huge strategic pivots.
Yeah, you can trace the strategy through the CEOs. We see a clear progression from the founding family to professional management. J. Larry Nichols, the co-founder's son, had an immense tenure. He led the company from 1980 to 2010.
So 30 years.
30 years. He oversaw the IPO and that initial massive global expansion phase we're about to talk about.
Then came John Richels from 2010 to 2015, followed by Dave Hager from 2015 to 2021.
And Hager's tenure perfectly encapsulates that period of intense cost-cutting and the final aggressive divestitures of the international portfolio.
The ones aimed at achieving that U.S. shale focus.
He was the executive who executed the come-home strategy.
And after him,
Subsequently, Rick Muncrief led the company from 2021 through 2025, a period defined by integrating major acquisitions like WPX and capitalizing on that new variable dividend structure.
looking ahead.
The current leadership plan has Clay Gaspar taking over as CEO and president starting in 2025. This continuous managed transition suggests a deep bench and a highly strategic focus that, it transcends individual leaders. It ensures the core direction remains intact.
All right, let's get into the deal-making. Here's where it gets really interesting, just charting the sheer scale and audacity of their M&A strategy.
It's the core of their story.
It is. Devon's history is defined by these massive, multi-billion-dollar deals that radically reshaped its footprint. They moved from being a regional Oklahoma player to a global entity, and then all the way back to a focused, hyper-efficient U.S. giant.
We need to trace this in phases because the why behind each transaction changes over time.
Exactly. And this timeline, it's more than just a list of dollars and dates.
It's a history of how independent oil companies hunted for value all across the globe before the shale revolution provided a better domestic alternative. It shows opportunistic growth and bold, often very risky, bets on future resources.
Okay, let's start with phase one, the early expansion and diversification. We're in the 1990s and early 2000s, where they built their conventional foundation.
It started relatively small.
In 1992, they acquired Hondo Oil and Gas for a relatively modest $122 million. But this was foundational. It secured not just oil and gas reserves, but also 7 natural gas processing plants.
Which immediately integrated essential midstream capabilities.
The plumbing.
The ability to transport and process the fuel right alongside their upstream production. That's a key early move.
4 years later, 1996, they bought assets from Kerr-McGee for $250 million. This brought in North American onshore properties.
But the crucial long-term value was the 370,000 net acres of undeveloped drilling rights.
So they were buying potential.
This was acreage banking, a bet on future potential, securing land that they knew would become highly valuable as technology improved over time.
Following that, we see phase two, the global push. This is when Devon transformed into a major international and offshore player. This is them really swinging for the fences.
Absolutely. The scale of the deals just explodes here.
In 1998, North Star Energy was acquired for $750 million. This gave them their first significant entry into Canadian properties.
Then came the move into deep water. In 1999, they acquired Penn Energy for a cool $2.2 billion.
And that brought them significant oil and gas properties in the Gulf of Mexico.
At the time, the Gulf of Mexico, with its high-pressure deep-water sites, was the ultimate prize in conventional energy. It was the highest risk, but also the highest reward.
And the diversification continued. In 2000, Santa Fe Snyder for $3.35 billion.
And that package was geographically diverse. It gave them an early entry into the crucial Permian Basin, assets in the Rockies, and even more Gulf of Mexico sites.
So they were trying to be everywhere at once.
They were aiming for resilience by spreading risk across multiple conventional basins, both domestic and offshore. It was the standard playbook at the time.
The pace was just relentless. In September 2001, Devon made this enormous statement by acquiring Anderson Exploration for $4.6 billion.
That was a massive Canadian acquisition, so large, in fact, that it temporarily vaulted Devon to the status of North America's largest independent producer of oil and natural gas.
The biggest in North America.
For a time, yes. That deal alone signaled their ambition to just completely dominate the conventional energy landscape.
They capped off this whole global phase in 2003 with the $5.3 billion purchase of Ocean Energy.
Which significantly reinforced their presence in deep-water sites in the Gulf of Mexico. They were fully 100% committed to the deep conventional world.
And this is the pivot point.
This is the moment they demonstrated true foresight. Even while they were executing these massive conventional and global deals, They were simultaneously making the strategic move that would define their next 2 decades.
The shift to unconventional shale assets.
The 2002 acquisition of Mitchell Energy for $3.1 billion was, you could argue, the most crucial transaction in their entire history.
Why Mitchell specifically?
It gave them oil and gas properties in the Barnett Shale of Texas. Mitchell Energy was a true pioneer. George Mitchell was the father of shale gas.
So by buying them.
Devon acquired not just physical reserves, but proprietary technical knowledge regarding multi-stage hydraulic fracturing, the very techniques that would soon unlock the entire U.S. shale revolution.
Wow. So they were essentially buying the intellectual property and the first mover advantage in a technology that would fundamentally redefine global energy supply. Looking back, that's a genius move.
It was a massive bet on a revolutionary technology that was still, frankly, in its infancy. Many people thought it would never be economical at scale.
But they doubled down.
They did. In 2006, they acquired Sheaf Oil and Gas for $2.2 billion, specifically aimed at expanding their Barnett Shale leaseholds. This solidified their early dominant position in that critical unconventional play.
Which sets the stage perfectly for Phase 3, recent strategic acquisitions and hyperfocus. This is from 2014 to the present.
And this era is defined by aggressive buying in specific U.S. shale basins while simultaneously shedding everything else.
The deals remain massive, but the geography shrank dramatically. In February 2014, Devon acquired Southern Energy for a huge $6.1 billion.
Instantly gaining substantial assets in the Eagle Ford, another massive, liquid-rich, unconventional shale play in Texas.
And that move signaled their commitment to higher-margin, liquid-rich areas over dry gas.
It absolutely did. And later that year, they executed a key structural move. They merged their midstream assets with Crosstex Energy to form EnLink Midstream, LLC.
Right. Help the learner understand what midstream assets are and why spinning them off simplifies Devon's core business.
Okay, so midstream is the plumbing. It's the pipelines, the gathering systems, the processing facilities that take the raw product from the wellhead and prepare it for sale.
It's a whole separate business.
It is. It has different risk profiles, different capital requirements. By spinning it off, Devon simplified its balance sheet. They reduced their exposure to the regulatory complexity and heavy capital demands of running a pipeline business.
They wanted to be pure play upstream.
Focused solely on exploration and production, it maximized capital returns on their core competency, which was drilling holes in the ground.
So following that simplification, the focused spending just continued.
It did. In December 2015, they purchased Felix Energy for $2.5 billion, securing oil and gas properties in the Powder River Basin and the Anadarko Basin.
Strategically diversifying their premium shale exposure across the U.S. landmass.
Exactly. And then came the ultimate consolidation move, the merger with WPX Energy in January 2021, valued at $2.56 billion.
This deal was huge news at the time.
It was. It provided key assets in 2 of the most critical high-margin U.S. plays, the Williston Basin in North Dakota, and further consolidation in the highly profitable Permian Basin. This was the definitive strategic step to streamline their operations into the highest potential areas for oil and NGL production.
And we are seeing that focus maintained even today with aggressive, what they call infill and expansion purchases.
Right. This M&A isn't history. It's the ongoing reality of maintaining inventory.
What do you mean by that?
Well, shale wells decline very quickly. So to keep production flat, let alone grow it, you have to constantly be drilling new wells, which means you constantly need new high-quality locations to drill.
So you have to keep buying.
You have to. They are using their strong cash flow to surgically acquire smaller, highly strategic packages to bolt onto their existing core acreage, which increases efficiency.
Like what?
In 2022 alone, they purchased Rimrock Oil and Gas for $865 million, focused on Williston Basin assets, and then Validus Energy for $1.8 billion, which expanded their Eagle Ford footprint.
And as recently as October 2024, they completed another massive transaction.
Acquiring Grayston Mill for $5 billion, further expanding their already crucial presence in the Williston Basin. This continuous multi-billion-dollar acquisition cycle demonstrates that being a focused, independent energy giant means you are always in a perpetual race to secure more premium inventory.
But the narrative of Devon's corporate self-reinvention is only half told without the critical counter-strategy.
The divestitures.
The aggressive divestiture strategy. They didn't just buy big. They sold big and were absolutely ruthless about shedding anything that didn't fit the new, focused U.S. shale profile.
And this strategy is what funded the expansion and achieved that laser focus.
The first major move in this direction was enormous. The $7 billion sale in March 2010 to BP.
That single transaction for $7 billion systematically shed their highly complex, capital-intensive global assets. We're talking holdings in Brazil, Azerbaijan, and their deepwater sites in the Gulf of Mexico.
So this was the first monumental step in cleaning the slate.
Cleaning the slate of global conventional assets that were expensive and incredibly complex to manage compared to U.S. shale.
Then they turned their attention north.
They systematically offloaded their entire Canadian portfolio, the very same assets that had once made them North America's largest independent producer.
And that happened in two big chunks, right?
Right. We saw two major sales. One in 2014 for about 3.1 billion Canadian, and the final decisive exit in June 2019 for 3.8 billion Canadian.
Both to Canadian Natural Resources.
Correct. And the press release surrounding that 2019 sale was incredibly revealing.
What did it say?
They explicitly stated it was the final step to complete transformation to U.S. oil growth company.
Wow. That's a clear corporate mandate.
No ambiguity there. The era of global diversification was definitively over.
We also saw a significant domestic streamlining. In 2014, they sold 900,000 net acres across the Rockies, Mid-Continent, and other regions to Linn Energy for $2.3 billion.
Right. They were shedding disparate, non-core acreage, even if it was profitable, simply because it diluted their focus on the highest return shale plays. It was all about concentration.
And then perhaps the most symbolic divestiture of all.
Selling the very asset that launched their shale revolution.
In October 2020, they sold their entire Barnett Shale assets, the original Mitchell Energy properties, to BKV for $770 million.
It's an incredible move when you think about it.
So why? Why sell the cradle of your unconventional success?
Because the Barnett Shale, while revolutionary historically, had become primarily a dry natural gas play post-2010.
And dry gas typically offers lower margins than the liquid-rich plays they were focused on, like the Permian.
Exactly. They had maximized the value, they had proven the concept, and they ruthlessly moved on to the next better-performing higher-margin basins. The lesson here for the learner is that strategic focus in the energy sector is often achieved not just by what you acquire,
but by being absolutely ruthless about what you choose not to own. So what does this aggressive, decades-long strategy of buying, building, and divesting actually yield today? Where does Devon operate now, and what's in the ground?
The strategic vision is now crystal clear on the map.
And the result is a highly concentrated operational footprint.
Exclusively focused on the most prolific and cost-efficient hydrocarbon plays in the lower 48 states. This concentration is a key component of their efficiency model.
And where are those core operational basins specifically?
They're primarily focused on three interconnected regions, all centered around unconventional extraction. First, you have the Delaware Basin,
which is the western liquids-rich subbasin of the larger Permian in West Texas and New Mexico.
Correct. Second, the Eagle Ford Group in South Texas. And third, the Rocky Mountains.
And for Devon, the Rockies specifically means
the Williston Basin in North Dakota and the Powder River Basin in Wyoming.
These areas are the absolute premium acreage in the U.S. oil patch. Why are these specific basins superior today to, say, the conventional assets they sold in Canada or the deepwater sites they shed?
Well, it comes down to economics and efficiency. The key phrase is liquid-rich. That means when they drill horizontally and use multi-stage fracturing, they produce a mix of high-value crude oil, high-value natural gas liquids, or NGLs, and then also natural gas.
And the crude oil and NGLs often trade at a much higher margin than dry natural gas.
Much higher, so you get better returns on your investment. Furthermore, these basins allow for consistent, predictable drilling programs using pad drilling.
That's where multiple horizontal wells are drilled from a single surface location, right?
Right, which maximizes efficiency and minimizes the environmental footprint and overhead costs. It's like an assembly line.
Let's move from geography to geology and look at their proved reserves as of the end of 2024. This is the ultimate inventory that supports their $30.5 billion asset base.
Their total proved reserves stand at an immense 2,155 million barrels of oil equivalent.
Which is a vast supply of secured energy ready for future extraction.
It is. But the real insight for you, the learner, is the composition breakdown of those reserves. This mix tells us everything about how Devon manages commodity risk.
And this ties directly back to that variable dividend structure we talked about earlier.
It does. Their reserves are remarkably balanced. 42% is petroleum, so crude oil, 29% is natural gas liquids, NGLs, and the remaining 29% is natural gas.
That near 40-30-30 split is incredibly strategic. What does that balanced mix suggest about their ability to navigate those wild commodity market fluctuations?
It suggests tremendous strategic flexibility and resilience. You can think of it as an internal operational hedge.
Okay, break that down.
Let's look at the components. Crude oil is the primary driver of revenue, obviously, but natural gas liquids are essentially the building blocks for petrochemicals, things like ethane, propane, and butane.
So they have a different market.
They often trade based on completely different supply-demand dynamics. They're tied to global plastic and chemical manufacturing, not just home heating or electricity generation.
So if the price of crude oil takes a temporary collapse, like it did in 2016,
They still have two other strong revenue streams, gas and NGLs flowing from the very same wells to protect profitability.
right? Compare this to a company that is, say, 80% dry natural gas.
That company is highly vulnerable to seasonal gas price drops or pipeline congestion. Devon's diversified, balanced production minimizes this single commodity vulnerability.
It's operational hedging.
It's operational hedging achieved through expert geological planning and acreage selection. This balanced mix is arguably why they were able to pivot to that variable dividend structure so confidently back in 2021.
Okay, let's transition now. We've talked about operational efficiency, financial resilience. Let's talk about influence and accountability.
Right.
Energy companies operate at this intense intersection of business and policy, and Devon is a prime example of a corporation that actively seeks to shape the environment in which it operates.
It is the reality of operating at this scale. The cost of operations and, critically, the speed at which you can drill are heavily influenced by policy.
So they have to be involved.
Therefore, corporations dedicate substantial resources to political activity. Devon has contributed millions of dollars over the years to politicians and political organizations to ensure their interests are represented.
And the sources are pretty clear about where that funding goes.
Yes. And we have to impartially report this fact that the funding has gone almost entirely to organizations and individuals affiliated with the Republican Party.
Which indicates a clear political preference.
It does. And given the typical Republican stance on minimizing environmental oversight and maximizing access to fossil fuel extraction, this funding aligns directly with the company's core business interest.
Securing favorable, less restrictive operating conditions across their critical U.S. basins.
That's the goal.
This political investment appears to pay direct dividends, particularly when administrations change. We have documented evidence detailing an environmental regulation pivot that followed the 2016 election.
This is a classic example of policy impacting the bottom line. Devon had previously entered into voluntary agreements with the Obama administration to install specific systems designed to control the illegal emission of hazardous chemicals.
A necessary but costly compliance step to meet environmental standards.
Correct. But they reversed course on those commitments very quickly.
When the administration changed.
Precisely. They subsequently backed out of these agreements during the first presidency of Donald Trump, citing the regulatory rollbacks of environmental laws that occurred during that period.
What does that decision demonstrate?
It demonstrates the critical importance of government policy to their financial calculations. When the government signals a relaxation of enforcement or regulation, Devon acts quickly to minimize its compliance costs,
Which maximizes shareholder value in the short term.
but draws significant environmental scrutiny in the process.
This raises an important and, frankly, a deeply troubling question. How direct is the corporate hand in drafting the regulatory policies that affect them?
And this brings us to a case that is often cited as a prime example of regulatory capture. It was documented in a 2014 New York Times investigation.
What do they find?
The investigation focused on a 3-page letter sent to the U.S. Environmental Protection Agency, the EPA.
Okay.
This letter advocated for relaxing laws related to hydraulic fracturing. The letter was officially signed by Scott Pruitt, who at the time was the Attorney General of Oklahoma.
So the expectation is that the state attorney general's office drafted and supported that policy position.
That's the appearance. The surprising and highly provocative fact that the investigation uncovered was that the entire letter, from the legal arguments down to the formatting, was actually ghostwritten by lobbyists working directly for Devon Energy.
The lobbyists wrote the whole thing.
The whole thing. Pruitt simply put it on his letterhead, signed the finished product, and sent it off to the EPA.
Wow. That goes far beyond traditional lobbying. What are the broader implications of a corporation essentially writing the public policy position that a major elected official then formally adopts as his own?
It illustrates a blurring of the lines between private corporate interest and public enforcement mechanisms. It creates the appearance that the regulatory position being advocated is the government's independent decision.
When in fact the argument's genesis lies entirely with the private sector.
Right. For the learner, this is a powerful demonstration of how large energy corporations seek to shape the regulatory landscape. And it can, erode public trust in the independence of government oversight in the process. It's the ultimate insider political activity.
Beyond just political influence, Devon has faced several high-profile environmental and compliance issues that resulted in specific regulatory action and fines.
Right. This demonstrates that operational failures do occur even in highly efficient, focused systems.
Let's review the 2019 blowout incident in the Eagle Ford Shale. This was near Yorktown and Nordheim, Texas.
This was a significant operational failure. A natural gas well blowout that required authorities to seal off thousands of acres of surrounding land for 35 hours until the well could be capped.
An incident serious enough to require sealing off thousands of acres. That sounds like a major environmental and public safety threat. What was the financial consequence for the company?
Well, this is where the scale difference becomes startling. For this incident, which necessitated an emergency response and public land closure, the company paid a fine of $48,750.
$48,000.
Yes. When you measure that fine against their $15.9 billion annual revenue, it's a fraction of a percent, a rounding error.
Which raises crucial questions about the deterrent effect of these regulatory fines when you compare them to the vast revenue potential generated by continuous operations.
It suggests that the cost of cleanup and the public relations hit might far outweigh the actual regulatory penalty.
There was another, separate but equally important legal issue that emerged in 2021. This one was regarding federal compliance.
Right, specifically under the False Claims Act of 1863.
What happened there?
Devon agreed to pay a $6.15 million settlement to resolve allegations that the company violated the False Claims Act.
And the violation was?
Underpaying and underreporting royalties for natural gas produced from federal lands in Wyoming and New Mexico.
Okay, what exactly does underpaying and underreporting royalties mean in this context?
When energy is extracted from federal lands, the U.S. taxpayer is owed a predetermined royalty percentage based on the value of the extracted product.
So it's a fee for using public resources.
It is. The allegation here was that Devon systematically reported a lower value or quantity of gas extracted than was actually produced, or that they improperly deducted costs, which resulted in a lower royalty payment to the government.
So essentially cheating the public treasury.
That was the allegation. A $6.15 million settlement is significant. It indicates a serious compliance failure and underscores the high stakes involved when companies extract public resources and the government's commitment to recovering funds where reporting fraud is suspected.
We've covered such vast ground today, mapping Devon Energy's journey from its 1971 founding to becoming this laser-focused, multi-billion-dollar U.S. energy company.
It's quite a story.
It is. This trajectory has been defined by an aggressive, opportunistic corporate strategy, major financial pivots like that highly resilient fixed plus variable dividend.
And, critically, a direct and at times very controversial involvement in shaping regulatory policy,
Which has drawn significant scrutiny and resulted in legal settlements.
The key takeaways for the learner should really revolve around strategic scale and discipline. First, the sheer staggering volume of multi-billion-dollar M&A activity, both the acquisitions and the divestitures.
It's mind-boggling.
It is, and it demonstrates the only way an independent energy company today can consolidate power and transition from a regional player to a giant by ruthlessly buying and selling to achieve hyper-focus.
Second, the strategic and costly shift from global conventional assets to focused U.S. liquid-rich shale plays, the Permian, the Eagle Ford, the Williston.
That was not an accident. It was a disciplined decision to sacrifice complexity and lower margins for higher return, higher efficiency, unconventional operations.
And you can see that evidence in their highly optimized 42-29-29 reserve mix.
It's their whole strategy in 3 numbers.
And finally, The documented evidence of corporate involvement in shaping regulatory policy, highlighted by that Pruitt ghostwriting controversy and the regulatory rollbacks. It serves as a powerful illustration.
It shows that securing favorable operating conditions is often as critical to a massive energy company's success as possessing the best geological expertise. The political landscape is simply another field of play.
So, a final provocative thought.
Considering the company's continuous need for inventory, which we saw with that recent $5 billion purchase in the Williston Basin in late 2024, the question remains, what future role will this relentless cycle of M&A play?
Do they have to keep buying high-quality acreage just to stay flat?
And as that premium inventory becomes scarcer and more expensive, does that race for reserves force them into riskier financial strategies? Or does it generate even greater regulatory challenges and increase scrutiny on their pricing and their reporting compliance?
That continuous high-stakes race for the next best acre of land. That is definitely something worth mulling over long after this deep dive ends. Thank you for tuning in.